Hi everyone, welcome to Easy Peasy Millionaire, the YouTube channel where I'll show you how to grow your net worth to $1 million or more. Before we get started, I need to let you know that although I'm a Google attorney, that work that I do at Google is completely separate from this YouTube channel. This YouTube channel is in fact my personal passion project to bring financial knowledge and personal finance information to the general public. In today's video, we are going to be talking about why you should definitely invest in the stock market. The stock market is one of the most efficient ways in which you can grow your money. What do I mean by that? Let's take a look at an example. Let's assume I'm putting away $100 a month very diligently into my checking account, which has an interest rate of 0.01%. And I'm doing this for the long term. So every single month, I put away $100 for a span of, for example, 30 years. At the end of those 30 years, I'll have about $36,000 saved up in that account. That's not chump change, but what would happen if we did that differently? Let's assume you, being smarter than me, are doing the exact same thing, but instead of putting $100 into a checking account, you are putting that $100 into the stock market and investing that money into a diversified index fund. On average, an index fund that is well diversified, like the S&P 500, will give you about 10% yearly returns when invested for the long term. So at the end of that 30 years, your money, on the other hand, would have grown to a whopping $217,000. That is a huge difference, $36,000 versus $217,000. That is why the stock market is so powerful. In fact, if you were to diligently and patiently invest in the stock market month after month, after a certain period of time, you will definitely become a millionaire. In that example, you probably noticed that the only difference between the checking account and the stock market is the average annual rate of return. The checking account gave us a 0.01% interest, while the stock market gave us an average annual return of 10%. Now, where did I get that 10% from? That has been extensively researched by many folks, and one of them is Vanguard. So Vanguard actually looked at a period of almost 100 years and looked at a diversified index like the S&P 500. And based on this analysis, they concluded that you get a return of about 10% every single year, year after year, when you invest in an index like that for the long term. I'll put links to those studies in my show's notes, and you can always go ahead and take a look at that whenever you get a chance. That example that I just gave you illustrates a very powerful concept. However, you have to keep some very important guidelines in mind. First and foremost, when you invest in the stock market, you need to invest in a diversified fund like the S&P 500, not in individual stocks. Putting your money into individual stocks is just like gambling. So you can always go to Vegas and put your money on black at the roulette table and dump all your life savings on that, right? And you might walk away with a big chunk of cash. You can also lose everything. That's exactly how individual stocks operate. If you put your money in an individual stock, the risk is very concentrated on that single stock doing really well in the market. However, if you invest in a diversified index fund like the S&P 500, you're actually holding many companies at the same time. And that way your risk is much more spread out, and that index fund will perform really well in the long run. Second, when you invest in an index fund, you want to make sure that the yearly cost of this index fund is low. This yearly cost is indicated by something called the net expense ratio. Now, you want to make sure that expense ratio is lower than 0.2%. These low-cost index funds can be purchased at certain brokerage firms like Vanguard, Fidelity, Charles Schwab. I'm sure there are other firms out there that also sell low-cost index funds. Those are the three famous ones that I know about. And just for the record, they're not paying me to say that or anything. I just know that from personal experience. Third, you want to invest for the long term. What does long term actually mean? Long term means at least 20 years. Index funds in the short term are very volatile. They go up and down quite often. And that's what you hear on the news, on the radio, on podcasts, on TV. They're all talking about volatility. However, the volatility kind of goes like this, right? So that end point after 20 years will be much higher than that starting point, even though that index fund is doing this. One of the smartest and most successful investors in history, Mr. Warren Buffett, famously once said, "The biggest thing about making money is time." He also said, "You don't have to be particularly smart, you just need to be patient." That works out well for people like me because I'm not really sure how smart I am, but I certainly know that I can be patient. And last but not least, you have to leave that investment alone. Don't go in there and micromanage it, tinker with it, none of that. There's a paper written by two professors from the UC system, UC Berkeley and UC Davis. The paper is called Trading is Hazardous to Your Wealth. In this paper, the professors analyzed 66,000 households. And of those households, they found out that the households that traded the most and traded more frequently seriously underperformed the households that left their investments alone. All right, I've just hit you with a ton of information, and I'm sure you have a lot of questions. Questions like, what is an index fund? How do you invest in an index fund? How much money should I put in an index fund? And how to invest if the money is needed earlier than 20 years? We are going to answer all of these questions and a lot more in the coming up videos in this YouTube channel. In these videos, we will explore the foundational concepts of personal finance so that you know exactly what you're doing with your money and you can set yourself for success with regards to your financial future. And that means a more intentional life for you and more choices for you as time goes on. I definitely welcome your feedback about this channel and my videos. If you have any comments, please leave them in the comments section. And you can also directly email me at epmillionaire@gmail.com. And of course, if you like this video, please hit the like button and also subscribe to this YouTube channel so that you know when future videos come out. Okay, one final thing. Before you do anything with your money, don't just blindly trust the information given out by a random internet guy. Please do some due diligence. Make sure that information, one, makes sense by doing a little bit of research, and then two, make sure that applies to your specific situation, and then execute. That's it for today. I'll see you soon. Bye.